You know what's crazy? Most people think when you invest into the S&P 500, you're getting market returns, right? You basically invest in the 500 biggest companies in America. But what not many people know, that actually the majority of those companies within the S&P 500 underperform. Yes, I was also surprised, to be honest. So in this video, I want to go through, break it down so you really understand it, because I think that really matters, especially if you're planning or continue to invest into the S&P 500. Hi, and welcome back to the channel. My name is Kai. In this channel, I talk about all things money, personal finance, and investing. And yes, myself, I'm also a big advocate and investor myself into the S&P 500. And recently, I really took a deep dive and looked at the various companies in it to see how they actually perform. Because usually, when we talk about the S&P 500, we talk about market returns, right? And the S&P returned over the last 30 years on average year on year anywhere from 8 to 10%, which is really not too bad when you think about it. Of course, it means some years it overperformed and other years it slightly underperformed, but on average anywhere between those two numbers. And I thought more or less all those companies inside of it would probably perform in a similar level. Well, how wrong I was. In fact, here we see the percentage of those 500 companies inside the S&P 500 that have outperformed the S&P. So if the S&P, let's assume, returned 10% in a year, those percentages of companies have overperformed, meaning more than 10%, 11, 12 and upwards. So you can see back in the days in the 1980s, actually majority of companies did so, almost 70%. Then you have some other years also very high, but on average you could say around 50%, meaning 50% underperformed, 50% overperformed, which kind of makes sense, right? You would assume that obviously some companies slightly underperform while others slightly overperform. But then look at what happened back in 2023, 2024. There's such a major correction in companies that now overperform, meaning majority of the companies actually underperformed the S&P 500. Only a handful, in this case 23-24%, that's up to July 2024. Those companies managed to outperform. The rest actually underperformed. And that of course goes back to the big tech push we've seen in recent times, the AI hype, tech hype. All those companies have received so much money flowing into them, increasing their valuations and therefore gains in stock and share price, of course. That's why they have done so very well, even though other companies have still done well, right? Doesn't mean they're doing poorly, but compared to those tech companies at the very top, they have done relatively worse in comparison. And that's just incredible to see such a deviation. Now, of course, as an S&P 500 investor, you don't mind, right? Because ultimately you look at the total returns the ETF gives you that you invested in. But I think it's still important to see, because of course it bears certain risk, because if those few companies, let's take extreme example, let's say you have only 10% of companies doing better, the rest doing worse. So if those 10% of companies all of a sudden start also dropping, then of course the entire S&P will go down. Right, and here we have actually all the 500 companies that make up the S&P 500 listed by market capitalization. So how that works is basically the more valuable a company is, the more weighting it has. Meaning the 500 company, if I scroll down all the way to the end, which is currently the last company inside of it, well, it happens to be 503, so sometimes it's 502, 503, so but more or less 500. But let's take this example of 503rd company, News Corporation Class B. So that makes up only 0.01% of the weighting of the overall S&P 500. So even if they were to triple in value, right, a crazy increase in percentage in the share price, it really would move the needle of overall return of the S&P 500. Versus, of course, if any of the top companies in the top 10, especially the top 3, Apple, Microsoft, Nvidia, if they go up or down, that would be immediately affecting the S&P 500 returns. We've seen in recent times Nvidia having crazy returns this year, and that really has led to great returns of the S&P 500 so far. So the more valuable a company is, the higher the weighting. And you can see the top 10 companies alone make up almost 30% of the total weighting of the S&P 500. So really important, very powerful companies that have really a huge impact on the overall returns of the S&P 500. And the market capitalization, meaning the weighting and value of the company, is determined by the share price times the number of shares. Those two together give you the market capitalization, which then accordingly will be ranked. So the more valuable a company is, the higher its weighting. So when we jump over to Seeking Alpha, where I do all my stock research, and if you want to sign up, I have a link down in the description below. Amazing research, love it. You can find all the great insights. And here we're looking at the S&P 500 ETF, the SPY, the biggest S&P 500 ETF in the world. That's based in the US. It's not the one I'm buying, but it's just a good benchmark to see how the ETF S&P is doing actually. So when we click over here to year-to-date performance, we are up by 19.85%, which is absolutely mind-boggling. As I said, in the past, it was anywhere from 8 to 10%. So here we already double, and we're only in September, right? So let's see what percentage we will reach by end of the year. Maybe it goes down a little bit. We'll see some correction, even though I think personally, we might see continued growth. And as I mentioned before, that was fueled by a lot of the AI and tech frenzy in recent times, Nvidia and other companies who performed extremely strongly. So if we want to compare which companies have been doing better, then we want to look at any company that basically had a higher return than 19.85%. And any company that had a lower return than that year to date, basically I would consider in this case underperforming. So let's have a look and see what results we come to. Right, so here we are back with the S&P 500 companies, but this time listed by the year to date returns, meaning from January 1st until today, the total return they have generated. So instead of market capitalization, we are ranking it by the returns they generated year to date. And you can see at the top actually a company I personally never heard of. Even though I invested into the S&P 500, I never even heard of that company, Vistra. But they managed to return 180% in this year alone. Shortly after, followed by Nvidia, which of course most of you probably heard by now. Very strong company, has been doing extremely well, and I wouldn't be surprised if we see even further growth in the near future. Another Constellation energy company, and of course Palantir, they recently just entered the S&P 500. They've done also tremendously well, so really great returns, which of course also fueled the S&P 500 returns there. And you can see a number of different companies that personally, many of which I never heard of. Literally most of them, all the way maybe until here, Oracle 15th, those companies have put in solid returns. Now granted, of course, they might be probably smaller companies, therefore their weighting is less, and therefore also the overall impact on the S&P 500 returns a little bit less than some of the bigger players, but still great to see those massive returns of some of them. Of course, Broadcom, another strong company we've seen doing very well and high ranked inside the S&P, had also had a stellar year this far. And yeah, a number of other companies. But of course, I want to go down to a cutoff point of 19.85%. So let's go down over here and see where is that point, 19.85%. I'm scrolling and scrolling. Obviously, a lot of companies in the S&P 500, but let's go down. We're almost there, 19.92. So it's still above. And then we come to 170th place, 19.78. So this is the cutoff point. So what that tells us is that year to date, from the beginning of the year until today, only 169 companies outperformed the market, so to say, the overall return, the average return of the S&P 500, which has been, as we saw so far, 19.85%. So if I take that 169 over 500 companies, it's pretty much 33%, meaning 1/3 of companies within the 500 companies outperformed the average, which at the same time also means that 2/3 of those companies, or 67% around, underperformed the overall average returns, meaning all those companies that you see over here, while they're still in the plus, some of them will also have a few negative ones, you see in a moment, but still all of them had actually lower returns than the average return the S&P 500 had. So you can see it's obviously a cocktail of all of those companies, but at the same time it just means if you would have invested into any of those individually, your returns would have been less than if you would have invested into all of them through an S&P 500 ETF. Just shows you it's going to be very hard to consistently outperform the market. And it also means when you look at this, 121 companies actually returned negative returns. So they lost you money if you would have invested into them individually, which is almost 24%, almost 1/4 of all companies in the S&P 500 had negative returns, which is absolutely mind-boggling when you think about it, right? Imagine you would have invested into any of those. Chevron, for example, right? A big popular company, Philips, MSCI, even Airbnb, some big names over there. Even Tesla still in the red over there. Walgreens, a big company, down 66% year to date. I mean, it's unbelievable. I mean, really shocking. Lululemon, down 48%. So yeah, honestly, guys, when I saw those numbers, I was really shocked and surprised, to be honest. While I'm always looking at the average market returns, when we're talking about the S&P 500, it seems so normal, you know, talk about 8 to 10%. A lot of people say even it's boring, right? Because it's so predictable. But at the same time, when you really dive into it, you see what's actually going on. Some companies are really thriving and doing so well, while many other companies are doing average, if not worse, and losing your money. So the odds of finding the company to outperform the market is just, for me, so very difficult. I don't know about you, but it reminds me of going to the supermarket and trying to find the perfect avocado, right? You think you got the right one, you come home, you cut it open, you think, my goodness, I just grabbed the wrong one. Either it's overly ripe, it's already brown, or it's not ripe enough and it's so hard to eat. And for me, that's so similar, like finding the right and perfect stock, because you see the odds are against you. Like in the casino as well, the bank always wins. Well, here the market usually wins. And that's why I don't have the illusion that I think I can outperform the market. And most people over the long term, they won't do either. Why even bother trying and wasting so much time away when you can instead automate your investments into the S&P 500, set it and forget it, you get your returns, and you don't have to spend all your time and hours trying to beat the market when in reality, many professional investors even can't. So what makes you think you can do this? And that's why I'm a big fan of passively investing into a low-cost index fund, such as the S&P 500. And guys, obviously, I'm only talking about S&P 500 here, but there are many other great funds that you could also invest. There are global world ETFs out there. They're maybe slightly more expensive for the management fee, but they can give you global diversity if that's what you're after. Even though personally, I'm a big fan of investing into the USA. It's a strong, mature international market that has transparency and shown time over time its growth potential. And well, honestly, I don't see any other market in the world that I'd rather invest in. And that's why I might as well put my money where my mouth is, into the strongest market that I personally think, at least for the coming future. Who knows what happens in 30, 40 years, but for the time being, I'm really happy with them. I'll continue investing into the S&P 500. If you enjoyed this video, please give it a like, subscribe to the channel so you don't miss any future videos. And if you enjoyed this video, then definitely check out this video over here, where I give you even more deep dive into the S&P 500, what it is, how it's composed of, so you can make the right investment decision for yourself. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.